Made it happen, Rob.
Well, good.
My favorite accountant.
Well, thank you. You're not too bad yourself, Josh.
I do my best. So happy to have you on. I mean, Rob, you've been in accounting for what? Is it been 25, 30 years now? And your background is in like, you know, businesses, corporate, like CFO in a box kind of thing. Like explain like your
Correct.
background just for anyone.
My entire professional career has been in accounting/finance. If we can go back to pre-internet in 1990, when I graduated college, I started at Deloitte. We did auditing actually on green paper with pencil. And it's not an urban legend. There was one laser printer on the floor, but we actually had to make an appointment to use that for final reports. So I did that. Then I did private
Does anyone
accounting.
do paper returns still?
There are requirements up till a couple of years ago. Actually, the IRS required paper returns for amended returns because they were all viewed by humans. And there are instances with weird deductions or credits where they still require paper returns, but basically they want everything e-filed. So anyway, getting back, so 30 some odd years, private accounting, public accounting. My last job where I was, quote, gainfully employed, I was the CFO of a wealth management firm in Sandy Springs in the Atlanta area, and lost my job like every other good person back then. It was really a bad time. And I said, that's it. I'm putting out my shingle and I'm going to go on my own. And that was in 2010. And I can tell you a lot more, but 15 years now on my own and I'm doing all right.
Yeah. 15 years is better than most when it comes to business.
Yep, that's correct. I tell any entrepreneur, you need to have money to live for 12 months. I don't care what your product is, what the secret sauce is. There's investments in marketing, technology, getting your name out, especially in intangibles like what you and I do for a living. It takes time to build trust through the referral network, and the seeds you lay for the first month and to the first year will pay dividends. It just takes time.
Yeah, and we were chatting before. You just went to a networking event in Orlando. Compared to when you first started 15 years ago, how has that evolved from when you first started to your most recent networking event? Did you notice anything that was different or similarities? Or tell us about that.
This was the first networking event I went to where I knew the attendees were not, most of them were not CPAs. Most of them were bookkeepers. And I did that for two reasons. One, our firm is a consulting bench. We don't have any employees. Everybody we do has their own business and things are private labeled. And a lot of my bookkeepers are, pretty full or retiring, and you always have to keep that open, which was one of my interests in that area. But the other thing, candidly, was more motivational, big picture, something that, I don't really do that often. I just thought, would be fun to do, try something different. And I got to go to Orlando in the hottest month of the year, pretty much.
Yeah. One of the only cities in Florida that is not at a beach.
Correct.
But they have Disney World.
They have Disney World, and they have a target audience that won't go away. So it's great marketing job for Disney. And obviously they're there for reasons. They got cheap land many years ago when they opened up Disney, and great business model.
Yeah, when they I don't know if you've read on it, but everyone was like, why would anyone buy this land in the middle of Florida?
Well, I know part of the story, you don't, without going into too much details. He bought lot by lot under various business names and had friends buy the lots for him because he did not want to give the notice that he was acquiring the land. So that is not an urban legend as well. That's the truth. And then, the rest is history. Disney.
Yeah. The happiest place on earth, so they say.
Yeah, so they say.
So with because like bookkeeping, I've been finding working with some business owners that they have no idea like how they do bookkeeping, and then they end up having terrible records, and then they go to their accountant and then complain that like, yeah, the accountants are too expensive, but it's because like nothing is organized. So I've actually been helping some folks with QuickBooks, bookkeeping, just some basic things in terms of like at least making sure profit and loss statement, reconciliation, making sure everything is, you know, taken care of. Talking about distributions, running payroll, especially if you're an S corporation.
Yep.
Like, what have you been seeing with bookkeeping with the business owners that you work with that has allowed them to flourish in their companies? Because a lot of people look at it as like a, it's something they know it's important, but a lot of business owners, especially when you're focusing on the big picture in terms of finding clients, bookkeeping and accounting are typically thrown into the I'll do it later pile.
Yes, it's all the important but not urgent. And I will look clients straight in the eye or tell them on the telephone, bookkeeping is the bones, and it's more important than, or as important to the relationship with your tax preparer. Because without good numbers, any advice a CPA or even financial advisor will give, um, it's bad. It's not going to work.
Yeah.
The bookkeeping is the bones, and I think any CPA you talk to, they'll complain about QuickBooks and blah blah blah. And QuickBooks has its problems, but the big problems QuickBooks has is that it gives a false sense of security on entries when non-bookkeepers and non-accounting people try to take it up as a side hustle. So going
Mm-hmm.
back to your original point, and it's a salesy term, but it's the truth. Bookkeeping is an investment; it's not an expense. And most business owners don't appreciate the value of the bookkeeping. They view it as a necessary evil, and then it rolls up to the CPA, and then the CPA or other accountant type person is making decisions based on that data. And if there's one thing your audience needs to know, profit and loss is not cash flow. Sometimes it is, most of the time it's not. And a business owner should think cash flow because that's what keeps the lights on. Okay. But the way P&L is determined includes cash flow, and it also includes other items like depreciation and fixed asset purchases, like the fund expensing my car payment. No, a car payment is not an expense; it's a reduction of debt. These types of
Mm-hmm.
things. So, I like to call myself a doctor of numbers. I could look at a P&L pretty quickly and see whether it was prepared by someone that has some sense. And I'm not trying to say they need to be a degreed accountant, but they have to have a background in bookkeeping and debits and credits.
Yeah, one of the business owners I was working with, I looked at his QuickBooks and I said, in order to fix this is going to cost you a fortune. It's better just to push the red button and just basically start over. It was just like how crazy it was looking. I was just like, this is not good in terms of like organization. So essentially, the things with bookkeeping, like you don't understand, is like, hey, like you can't just rely on QuickBooks to like feed everything in
Yes,
from your bank. Especially like JP Morgan Chase, like I've noticed they do things a little differently than other banks when I'm looking at their bank statements. And so when you're like uploading things, you have to like, I've been finding doing the manual uploads is actually quicker than relying on the technology because I find that the automation causes a lot of issues with certain banks versus
it does.
others. I don't know if
And
you've
it gives a
experienced
false
that.
sense of security. It's funny you mentioned that because we're onboarding a new client. And I told the client the first month to two, probably 2 months, regardless of your feeds, we're going to do everything manually. Takes a little more
Mhm.
time, will cost a little more. But why we do that, obviously, is that we code each transaction, we learn the vendors, we understand the setup of the P&L. Then, when we're comfortable with the credit cards and the bank accounts and all that, we'll turn the feeds on, and then we'll review where the feeds are putting those entries. It's a false sense of security on the downloads, and it makes the business owner lazy, not intentionally, but they have a million other things to do, and they're putting a reliance on those feeds, which can be problematic. A lot of dupes, but worse, misclassified things, which is then giving the bad story to the business on where the money is actually being expensed. It's kind of like having 20 charges for Amazon every month and coding them all to office supplies. It happens.
A lot of people do that.
Yep. Yep.
But on the diving deeper, I mean, when you do reconciliation, I mean, you need the physical statement anyway, like
Yes.
to review all the transactions. So, I mean, it seems a little strange, but I mean, sometimes just doing it the manual way. I mean, you're still using tech. I mean, you're not like uploading them one by one
Right.
individually. Like you can still upload the statements. It's just uh, I, I've reviewed. I get some business owners asking for help. I'm like, all right, I'll look at your QuickBooks. I'm not like a CPA or bookkeeping expert, but I can at least take a look and tell you where you're at. And then sometimes I look at it, I'm like, all right, this is salvageable. Other times I'm like, you're better off just starting over because in order to repair this problem, it's going to
Well,
be crazy.
just like employees have to do things on their desk they don't like to do, a business owner has to understand something that they think they don't want to deal with because they're too busy making something or selling something. So they need to understand their P&Ls. A negative accounts receivable or a negative accounts payable on a financial statement is a problem, right? So a negative credit card tells me that you've made the payment on the credit card, but you haven't recorded the expenses. But to a layperson, that should tell you you've overpaid the credit card. You do a refund, which is how I start with clients. And they're like, oh no, American Express doesn't owe us a refund. Well, those expenses have not been coded. Otherwise, it won't be negative. And they should be able to see that before they pass that to their CPA. Happens all
Yeah.
the time. Yep. And
So American
the
Express will just overcharge people on their credit card.
no, they'll pay the American Express
What?
against expenses that have not been charged, not been recorded. So it looks like you're paying Amex, but you don't owe them anything because they're not offsetting each other. That's
Is
just one
that
example.
called like tying out?
Yeah, like tying out. That's like not coding your Amexes and just paying the Amex every month. Up, I owe them 5,200. Boom, I pay Amex, and now you have money going out. The payable against the expenses haven't been set up, and there's various derivations about that, but you got the point. I mean, that's a flag. At a minimum, it's a flag.
Totally. Yeah. I mean, a lot of business owners, once they start making good money, they will talk to an accountant and be like, I'm going to go buy I'm just making something up, a Cybertruck because I want to be able to depreciate it. I don't want to pay taxes. From your point of view, what would be better options to avoid paying taxes while being able to build something rather than just buying expensive things through a business?
Well, two things. One, people think a tax deduction is a tax credit. Okay, you have to pay $1 to get some level of deduction off that. So, like you said, even in your truck example, just to keep the numbers clean, if you spend 100,000 on a truck and just keep the numbers simple, get a $40,000 deduction, you're still 60,000 out. Okay. So do you really need that truck? Okay. And the top level at the IRS will tell you about, is it ordinary and necessary? Okay. And of
Hmm.
course, there are certain things that are definitely ordinary and necessary. There's gray areas. Okay. And then there are things that are not ordinary and necessary, right? Like if you have a florist shop having two Lamborghinis owned by the business, that's a blatant example of not ordinary and necessary. But if you pay a little more for your van because you want it to last a little longer, we can make an argument there. The other thing is there's no free lunch. So, right. So you just not getting into specifics, but if you utilize some of those strategies where we even decide that they're legal and it makes some sense, you're borrowing from Peter to pay Paul. So if you did take a large deduction on an asset, yes, you're going to save taxes this year. But with the proper, CFO planning or controller planning, if you have a better year next year, you've lost that deduction for the year where you're probably going to be in a higher bracket. So even though you're saving now, you're going to wind up losing more next year because you didn't do the appropriate planning. But depreciation is just really a cost recovery system. So the best way to save on your taxes is to, one, avoid penalties and interest, making sure you're making your quarterly payments. Two, legitimately work and do things with your asset planning, like in Q4, where if you're going to buy things, buy them because you need them, not because to save on taxes. People, they have this real hard problem where they would rather spend more. Like I said, they would rather spend more money to avoid the tax, even if they don't necessarily need something. It's like they're beating the government somehow. But to answer your question, my first look at that would be is the company structure. Are they an LLC on a Schedule C? You know, everyone wants to be an S corp because there's some kind of like tax loophole, which may or may not be the case. Okay, and then the C corps are
Mhm.
like, they're like completely out of vogue, but they actually have a very good place with appropriate planning and peeling away the onion about the shareholder's life. So again, we have this big, beautiful bill that will be signed shortly with some types of changes. I don't really want to discuss that because until it's on the president's desk, we don't want to speculate. But people talk to their friends and see things on the internet. And again, they say, I want that for my business when it may or may not be the case. So,
Yeah, I mean, we don't know if that bill's even gonna pass, and, uh, isn't, like, the other tax laws, like, about the sunset, like, estate tax laws and things like that? Because tax laws have, like, a shelf life, don't they?
yeah, the back in 2017, when most of this was originally passed, most of what was passed, quote, back in the day, if I can believe 2017 is back in the day, is set to sunset and expire this year, which has made tax planning very difficult. And if you pull the noise away, the estate tax rarely, I mean, it certainly doesn't impact the middle class, and it also doesn't really impact the lower wealthy. I think it's like 12 million or change. They keep on updating it for inflation. Estate of tax is not really my area, but if you're a married couple, you got like $24 million that you can work around, and that's a whole other subject. But the truth be told, they could cut it to $1 million like it was back 20 years ago. It's not going to raise enough money to really impact any budget or budget deficit, which is why it doesn't really get the headlines. It's more of a, you know, it's a headline thing.
Yeah, I mean, I get lots of questions, especially, I mean, whether you're making 70,000, 50,000, $500,000 a year, one of the main questions I'm always getting is like, how can I save money on taxes? How can I save money on taxes? And
Well,
if you're an employee, there's only, I mean, so many things you could do.
as an employee, candidly, there's almost nothing you can do at this point besides the 401k or 403b retirement options that your employer has. And they're far from perfect, but they're the best things right now that employees have. Even if your company does not give a match, pay yourself first, even if it's $50 a paycheck or whatever a month. You'd be surprised what that will turn into in 5 or 6 years with compounding. And I'm sure you tell your
Mhm.
clients, compound interest is the biggest gift to anybody. I mean, you take someone in their 20s, they put a chunk of money away, and then life changes and things get hard. They can't afford to save even 10 or 20 grand over a few years, 30, 40 years down the road, what that'll be worth. But you can't catch up. You can't do that at 50 or 55. Even if you can save more, the time is not on your side. So compounding is what I tell my clients. Compounding is what you should tell your clients.
Yeah, I
Um,
mean, if I didn't invest, I would probably still be in corporate America, but I was able to invest early and made some smart moves and was able to use that to fund the dream. And then,
well, that's right.
funding the
That's
dream
right.
in the
And
beginning is a little tough to save.
my late business partner, he loved to say never. And I used to give him a hard time because I'm of the mindset sometimes it's never. But you know what? You got to be careful when you say that. So if you would have told somebody 20 years ago or 30 years ago that one day Social Security would be taxable, they would laugh at you. They would say, absolutely not. We already pay taxes on that. Well, without going into the weeds, as we all know, because it's part of this whole big bill, that if you're making any type of money, without getting into the details, Social Security up to 85% of your check gets pulled into income for most taxpayers. Okay. Now, people love Roth IRAs. I love Roth IRAs. But to say 30 years from now, they may not be taxable, I don't know, because you never would have thought Social Security would be taxable. And I don't even know. Do you know in the current bill, did that actually get through that Social Security? I don't think it has. I think that's just the tips.
I'm not
I'm
sure.
not
I know
sure
the
either, but
tips were a big one.
the tips are a big one. But look, if you're asking me my opinion, Social Security should not be taxable. The people already pay taxes on that, and that should be tax exempt. And I think that's fair. We're not getting into politics here. You've already paid the tax on that money, but the government constantly needs to find new sources. So you have to be careful that advice does change, and it's very generational as well. So anyway, I know you touched on S corps. Reasonable compensation is a very hot topic right now, and I can tell you it's not $24,000 a year. And that's we go to these CPE classes and we get these IRS updates from some of the officials there, and people make up salaries and what they think reasonable is, and um, AI is going to increase these audits. I know it for a fact because I was told that last week at the conference. We had an IRS person there, and this whole big thing about IRS scaling back agents, and they're doing that because they have AI. So
Mhm.
the level of audits are going to go more paper. They're going to go more letters, which they are now. There'll be fewer agents looking for the bigger things, but AI is going to get you because it'll be very easy to go through those returns and find out what's not a reasonable comp. Um, for your audience, just if you don't know what reasonable comp is, based on what you earn in a S corp and your position at that S corp, the IRS is expecting you to take reasonable quote comp, which in layman's terms is what would you get paid, all things being equal, if you had a corporate job, right?
Mhm.
So if you're making 300 grand a year in your business and you're taking 80 grand a year, and you were out in corporate America and you were making 80 grand a year, you're fine. Okay. And again, there's gray areas, but they want the FICA money. And remember, everybody, you are paying state and federal tax on all your income, including the W 2. But what you're not paying is the FICA. And the FICA is the lifeblood of the budget, which keeps, the Social Security checks, the disability going. And that is the big savings. And in a lot of circumstances, Josh, it's a lot of money. So people get
Yeah.
greedy.
I've talked to some accountants and they've said anywhere from like a third to half, and it's based off it's based off the income of the business. Because I mean, if someone's running a business, but I mean, there's no profits in a corporation. I mean, technically, there's nothing to pay them,
Right.
right?
Well, right. If you're not making any money, you're not required to have reasonable comp. Okay. I
Okay.
mean, if you're making very little, we could look at the details there. But what this ties into, a lot of small businesses start out, they make some decent money the first 6 months, and then their best friend tells them, "Oh, you should be an S corp," and I tell them, "Let's talk about it," because there's no free lunch with an S corp. There's an S corp tax return, a lot more complex, a lot more costly. You're required to have payroll, like not distributions, everybody. That is not payroll. Payroll you have to run every month. I mean, every couple of weeks, every month. That costs money. And you are required, hear me, you are required to maintain financial statements. So your best chance on Excel doesn't cut the mustard, and there's compliance costs. So, so you have to be prepared for that. And at the end of the day, if your compensation isn't matching what a reasonable comp would be, you're actually losing money by becoming an S corp.
So if someone has, let's just say they're
So,
getting towards, let's say October of 2025, and they're like, oh, my S corporation, has good net income. We're at about $100,000 for the year. What are some strategies that they could do
mhm.
inside the business to help reduce that, so that way they can lower the amount of reasonable compensation that they would be required to take?
Okay, so the first thing, which we kind of touched on, let's go into year-end planning. What
Hmm.
does the business need? Not want. What does the business need between now and year end? That's step one. Is it, I don't know, computers, office equipment, things that they need that they've been putting off? Second, what does the business need? And again, this is January, February, early next year. can we move any of those expenses into December, right? Like, why show a higher P&L and then find out January 3rd, you come back from the holidays and you're buying things you easily could have bought. Okay.
Mhm.
Now the IRS is aware of that. That is tax avoidance. That's not tax. That's tax planning. It's not tax avoidance. But again, it has to be facts and circumstances. So you can't buy a year's worth of whatever in December for all of the following year. But to run the business in January, it'd be totally acceptable to buy those things in December. Okay. The other thing is back to what we talked about, retirement planning, which is where you come in. Do you want to set up a 401k plan for the business and do a match? Okay, that has to be done by October. Okay, or then there's simple IRAs and SEP IRAs, and you want to have the cash to fund those before the year is out or by the tax filing deadline. Okay, this is a public service announcement to everybody hearing this podcast. If you don't discuss these things with your accountant, CPA, whoever you're dealing with, by the time tax season comes along, the only thing that can be really done is retirement planning, IRAs, and some of that. And there's no other tax planning that can be done. The year's over. So that's why a lot of people have dysfunctional relationships with their CPA, because they don't want to think about it. Between Thanksgiving and Christmas, I say it's like the twilight zone. You wake up, it's the new year. Then they start thinking about taxes, and it's done. You're done. And the planning, to pay your planner a little extra in the fall to come up with a strategy, 9 times out of 10, if not 10 times out of 10, is going to cover the value on tax savings for that year. And remember,
Yeah.
this tax of, there's tax avoidance, there's tax planning, and there's tax evasion. Okay. So there's a difference, folks.
Yeah. I've been talking to a few business owners
a great
about
example in your world. What's that?
Oh, I was just saying, I was talking to a couple business owners. Like everyone's like, oh, I could do a SEP. Talk about the difference between like SEP IRAs and like doing like a solo 401k through like a company, how that could impact someone's taxes.
Okay, very interesting question.
Yeah.
The type of entity you have will help structure what is best for you. So, to keep it very simple, an IRA is an individual retirement account. Okay, that it's not a business account, it's tied to the person. Okay, and as far as I know, right now, there's only 3 types: there's your traditional IRA, there's your Roth IRA, and there's your non deductible IRA, which is a regular IRA. Okay. Everybody, there's an income limit to each of these. With a regular IRA, if you don't know, you put the money in, you get the tax deduction now, your money grows deferred, which is quite good. And the logic is when you begin to pull it out at 59 and a half or older, that you'll be in a lower tax bracket. But even if you're not, you got the power of that compounding that we spoke about over the years. With Roth, you don't get the benefit now. And as long as you keep it for a certain period of time, which is about 5 years, there's some other specifics there, that money will come out tax-free to you when you pull it out. Knock on wood, it'll remain the way. And that's why I'm encouraging a lot of people right now to do Roth, but don't do all Roth, right? Because you just don't know. Non-deductible backdoor Roths, you got to ask questions. It's too much for this podcast, everybody, but there's something called a pro rata rule. So if you do a backdoor Roth, which basically means do your non-deductible contribution and then convert it to a Roth, sounds like it's magic, but talk to your financial advisor, because when you pull the money out, the IRS will deem the taxable piece coming out first, which is not going to give you the benefit of the Roth. If you'd like to learn more of that, you can email me. But there's a lot of complication here. Solo 401ks are great because with a SEP, the SEP rules are clear. Okay, it's 25% of your W-2, or it's 25% of your self-employed business income after expenses, minus some adjustments. Okay, they're easy. If you can't figure the other things out, you should do it. But if you pay a little more attention, you can open up a solo 401k, which will then allow the taxpayer, and even if a spouse is included in the business, because you can have a spouse and still have a solo 401k, is a great way to get that right up to the current limit, which is what, 23 or 23.5 if you're under 50, something like that. That gets adjusted. And if you're over 50 years old, you get an extra bump up. And now there's been a couple of other changes as well. So asking them my question, if you want to pay attention and pay, just really focus and have the cash, the solo 401k tends to be the way to go. And of course, the IRS gives a limit each year on the maximum amount of deferred comp. I think it's 73,000 now. I should know some of this, but I know the rules and I know the numbers close enough. And like I said, they change every year. But you want to get that money in those accounts.
Right. And from what my understanding is,
touching on another savings thing.
Oh, it's all good. I was just saying, like, with the solo 401k, you're using money from inside the business to fund it, versus like a SEP, you're using money from outside the business to fund it.
Not necessarily. A SEP is self-employed pension, so it's still coming from the business. It's a business. It's in your own name with the business, but it's business money.
Got it. So for both
it's not a
accounts, for
traditional, it's not
anyone
an
that's listening,
individual IRA. It's a SEP IRA. That's the business of it.
so both of
That's
them, you're
correct.
still using
That's
funds
correct.
from
And
the
then- and
company.
I hate the term alphabet soup. Yes. Yes, except for a regular IRA using your personal money, which means you can theoretically take a distribution and then put it in the regular IRA.
Got it. Yeah, a lot of people get confused about that.
So yeah, you have to look at it all. I could tell you right now, we're not really touching on it because it doesn't really involve you and I direct. But a lot of times, life insurance is sold as a retirement vehicle. It's good under very specific circumstances, and those circumstances are you make a lot of money, 800,000 a year, million a year, consistently. You've maxed out every other item, profit sharing, 401k, the deferred retirement, whatever you have at work, and you still have extra money. Yes, there are some financial benefits. Life insurance is coded. What's the last word? It gets a better. I can't think of the word right now, but yes, life insurance is treated fair, very, very fair in the code, but it's not designed for younger people. And I mean permanent insurance. Okay. Everybody should have term insurance, which is called renting the insurance. But, whether you invest your own money or you work with someone like Josh, explain to them if you're putting money in a permanent life insurance policy, 93 times out of 100, it's not worth it. A lot of hidden expenses and commissions.
Yeah, totally. Especially if you're not
We're
like a
touching on a
business
lot
owner.
of things here today. I like it.
Yeah. Yeah. I mean, for business owners, it could be strategic tax
That's right.
planning.
It all sounds great on paper. It does. Correct. And you can only work with the part of the tax code that you know. And I guess advice, I say this to everybody, if people or friends or your relatives recommend you things, that's not necessarily a bad thing, but it may not be suitable to your circumstances. Okay. I've gotten into a few arguments with clients over the years where, their business partner could deduct something and then we did the return and then we didn't deduct it and they're getting mad at me. And I'm like, well, your business partner is a single mom. Her income's lower. She qualifies for that deduction. It is a legitimate deduction, but you and your family do not qualify because income is higher. And then they don't always understand that because the tax code, candidly, is way too complex. And I am all for a flat tax, which is beyond today's conversation. And they say, well, Rob, we get a lot of our money, a lot of our fees from CFO consulting, helping businesses plan and, improving their bottom line. Because as you know, a lot of businesses are owned by salespeople and technicians. Generally, they don't have a good accounting or finance background. So I'm all about the government doing flat tax and calculating a lot of this. In fact, I'm surprised we're not there. But as long as there's politics and lobbyists, we'll be in business for a while.
Yeah, for sure. And with accounting, what is one thing, Rob, that people believe
Yes.
about accounting that's actually not true?
One thing they believe about accounting that's not actually true. Well, first of all, they think accountants are boring, or they're not part of, I'll tell you, I'll make you laugh. Actuaries are worse as far as personality than accountants. Um, I think part of one thing I say about accountants, we're trained historians. And I think that is a true thing, especially as far as getting the CPA license. But one of the things that a lot of people don't understand about accountants is that over the last 20, 25 years, we're looking through the windshield now. Okay. More of us are looking forward for you than back. And that the tax return is only compliance. It's to get you through last year. Okay. I'm not saying there's not value there, but most of the value is what happens during the year. And I don't care if you have a candy shop or whether you have a roofing company. A great one is the accountants also help you run the business. And what I mean by that, people, I don't know if you've seen this or heard this, people kind of make up on their mind whether someone's a W-2 or a 1099. I'm like, there are rules on this. And this impacts Social Security. And you got to make sure your people are classified the right way. And they use bad verbiage. Oh, I have a contract. I have a 1099 employee. Well, that's not good. Are they a 1099 or are they an employee? The IRS cares. Okay. And why? It's ignorance. They don't want to learn. And the worst things you see, Josh, is they want the best of both worlds. So they want a 1099, but they want to control what they do. And I tell clients all the time, as soon as you control their employees, 1099s have projects and outcomes based on what they do. You can't tell a 1099, a worker, they can't take a long lunch or they don't work for you. They've been contracted. So as long as they meet deadlines and deliverables, that's one of the benefits of being a 1099. One of the non-benefits of being a 1099 is you're responsible for both sides of the FICA tax, which I don't know if your audience knows this. Everybody, Social Security is 15.3%. That's correct. You're only seeing half of that on your check. Your employer is matching that money. And I don't like to give the IRS credit for things, but they've done a very good job hiding that from the rank and file. It's a huge amount of money. And all this toying with the budget, most of it goes to Social Security and disability and other programs, which I think are very useful, but cost a lot of money.
Yeah. Well,
one thing I did want to touch on is I've mentioned before, Josh, about people's avoidance to pay tax. One of the things I see, and if you're not seeing this, I would encourage this with your clients, municipal bonds. People don't understand that sometimes you're better off buying a corporate bond and paying the tax. You come out ahead. Some people just don't want to pay the government, and they love the muni bonds. They think they're beating the system somehow, and they're actually leaving money on the table. They don't want to hear it. Some clients, they just like it. Yeah, I'll give up a little, but I like the fact there's a lot of psychology to money. You know that. You've done these podcasts a long time. It's very, very interesting what you see with people. Other thing I'd like to remind your clients, especially if you're self-employed, you are required to make estimated payments 4 times a year: April, June, September, and January. It's not optional. If you wait all year, you will have penalties because the IRS feels if you're self-employed, you can pay 4 times a year. Some people don't care. They'll pay the penalty. Why? Because they feel good about holding on their money all year. Completely irrational. I see that too.
Well, people are going to do what people want to do.
So one of my questions I have for you is, how often does the taxes or consequences on the short-term and long-term capital gains come in your practice? Do people actually ask about that when they invest?
Never. So the way I set everything up
Never.
in taxable accounts is make sure if we're selling the position with the highest cost basis first. So essentially on any account opening, I set it up to maximize long-term loss. So essentially it'll automatically sell things at a loss. So essentially we could have a client who has a paper loss, and when they file their taxes, they could take the $3,000 deduction and carry forward anything else. And
Yes.
if the market's up that year, they've actually made money, but they've lost money.
Yes, exactly. And that, and your 3,000 comment is something I've been all over the fact that that number, everybody, has not been adjusted, I think, in 50 years. So a lot of the numbers that the IRS gives out are annually indexed. That 3,000 was probably worth 12, 15,000 today. I'm just trying to run the inflation calculator through my head. So
way
if
more
you have
than
a
that.
net loss after, right, exactly. So what I'm saying is that capital losses fully offset capital gains, going net loss 3,000, but they carry forward forever. And if you have a large amount of losses, you have to work with your financial advisor to basically suck that up like a sponge during the year to get those gains down. And when you are short term, which means 12 months or less, that's like your paycheck. It's ordinary income. No taxes have been paid on it. And you may have estimated payments as well. And long-term capital gains are treated more fairly in the code. Politics aside, that makes sense to me, and that seems that it's fair. But that's not that easy either. And there's a lot of rules around that. But ideally, you want to hold your investments more than 12 months.
Yeah, in a perfect world, sometimes it makes sense to not hold them for longer than 12 months, and that's
Correct.
where it's important to take advantage of certain strategies, so that way you can avoid as much tax as possible.
Yes, and exactly right. Money managers or mutual funds that tend to trade frequently, all things being equal, Josh, as you know, those accounts should be in retirement accounts. Keeps the math and accounting simple, and it's easier to track. Okay, and let's not even get started in imputed the capital gain distributions on funds in December. Boy, is that a hard subject. Again, to the audience, if you don't know how that works, they're actually taking out part of the NAV at the end of the year, issuing it as a distribution, okay? And then most of you are reinvesting it back into the fund. If it's not an IRA, that is creating a tax bill for you. Completely legal. They're not required to make the distribution, but most of them do. And those types of accounts with large capital gain distributions, those should be in your IRA. In fact, Josh, you probably know this. Didn't Vanguard get into trouble a couple of years ago with some incredibly large distributions that caused mega bills for a lot of the clients? And the scope of that was they should have disclosed to those clients earlier that were holding that fund that they were going to make a large distribution. So research it if you don't know about it. It's pretty good. I mean, a lot of money, like $20 to $25 a share distribution on some like a fund, if my memory's right. So.
Yep. Low fees though.
Yes, exactly. What was I was going to just say something else. So yeah, just remember, everyone, a dollar is not always a dollar. People go through life's changes. If you have money in retirement accounts, that's pre-tax dollars. No one's paid anything yet. UGMA accounts or accounts for children, they all have their rules. Kiddie tax have rules. If you think you're going to save money by putting a lot of money in your kid's name to avoid your tax, again, very complicated beyond today, but there is a kiddie tax. What you need to know is under most circumstances, they will be paying it at your rate. So there's no way around that either.
Sweet.
So, well, it's a lot different today.
Yeah. Well, thanks, Rob, the Florida Georgia CPA, hopping on. We'll see everyone next time. Bye.